Hello everyone and welcome back to the channel. Today we're gonna go through this Excel file here, which I received from someone that I'm supporting or coaching in order to get a better understanding how financial model works. And she received this file here from a job interview she was participating on. And now I'm just gonna go through here to check or for you to see how I would go about doing this on my own, right? And the first thing I would do here is just to look on the overall structure of the file and see what am I expect to do, right? Because I have no idea, right? For sure, this model here is not exactly the way I'm used to do my own models. So the first thing I would do is just to go through the model, see what the structure is, see how detailed the model is, and what I would be expect to do. So first thing, I would look on the how many sheets we have and what are the type of the sheets. That would already give me a good understanding of like how complex the model is and what I should be doing, right? So from here I can see we have an inputs general sheet, which is this one in here, and I'm sure I have to give some inputs in here, eventually do some calculations. Then we have a pro forma or the cash flows itself, because we have the cash flows here. I can see there are some yellow background here. So I'm expecting to fill out some information in here, do some calculations also, but I can also see there's information given to me, right? So I think it's going to be a mix of getting information, calculating, and make sure everything is structured in the correct and nice way. So we have the revenue, we have the production, price, revenue, everything very straightforward, operations, tax, EBITDA, and then we have what they call here leverage cash flows. And we have some schedules here for tax credits schedules or production tax reduction, right? Okay, that's cool. So that's what we have in here. And then last we have term loans. So I'm expecting here to be doing some sort of calculation on how much debt we can take, right? So or calculate the debt itself in here. What is the maximum we can get it, and whether it's going to be some sort of project finance structure or like more corporate finance. So that's more or less what I'm expecting here, right? That's it. Okay, I think that's enough for now. Then the next step, my second step would be, okay, so what is in the inputs sheet? Okay, so what am I supposed to be calculating in here? And start looking already on the standards that the model uses, right? To really understand what is input from me, what has to be calculations, right? And the problem here that like I can see some inputs already given, right? So not sure if I have been given all the inputs I need, and the only thing I need to do now is calculations. I have to come up with inputs myself or ask the interviewer whether this is the case or not, right? Let's see here. We have basically here 3 or 4 sections. We have project information section, and then we have some data for the project, so the name, the financial close date, end of the year, the COD date, okay, commercial operational date. So we're going to have a 1-year construction period in here. That's important. Commercial operational date start year, so it's going to start production in 2023. It just gets the year in here. Let's see, it's a bit weird because here the COD is the last day of the year. So apparently the COD should be 2024. Actually, I would add 1 day in here just to make things easier, right? Project cost, $500 million. Okay, so it should be quite big project. We have 100 WTGs, and WTG in this case here means wind turbine generator. So we have 100 of them. The average rate is 3.4 megawatt, okay, or 3,400 megawatts. I think here we have to calculate the capacity. That's cool. NCF should be the capacity factor of the wind farm. It's 40%. Then we are expected to calculate the annual production here. That's cool. Project rates. So we have here the O&M inflation deflator. I'm assuming this is how much we have to escalate our O&M costs. And we have the federal income tax. Look, that tax, sorry. Then we have a PPA. So we're going to have some sort of PPA for the full project. And we don't know who the counterpart is. Doesn't really matter. It's a 12 years PPA. We have 250 megawatts of contract capacity, I'm assuming. $18 per megawatt hour. And we're going to escalate it by 2%. That's fine. And then we have to calculate most likely the leverage returns, right? So in the 30 years after tax IRR and the NPV. Not sure which AT means, should be after tax, I hope, right? Let's see, not really sure. And if I were her in this particular position, I mean, this question is coming up, I would either take notes or I would already ask the interviewer what are these, just to clarify, right? If I were the interviewer in this case here, my expectations are that you go there and know everything, right? I think there are a few things that you can ask. And if I were interviewing someone in this case, I just want to know like how much the person understands about what's being asked and how comfortable or how much knowledge the person has about going to develop the financial model, right? So I would be very happy if I were interviewing, people were asking me already, like clarifying these questions, right? Okay, can I assume that everything in blue color here is an input from the model? Yes or no? Can I assume here that I have to input or to calculate everything that's in yellow background? So I think all these things are very useful, not only for you, but like it's going to give the interviewer a very good impression on how much you know already about financial modeling. But that's okay. So that's for the inputs general. Let's gonna go now and calculate the thing, right? Because we can calculate this, the site capacity, right? So the site capacity is in megawatts. So it's going to be what equals what? This number here times this divided by 1000. We need to be very mindful of the units. So we're going to have a 340 megawatts site. Okay. And now we have to calculate the annual production. So that's going to be what? It's going to be equals to the 340 times the capacity factor. So I'm assuming, okay, I don't know what NECF is saying. I mean, essentially, it's not written here. So I'm assuming it's a capacity factor. So you got to ask the interviewer, is it the capacity factor of the power plant? So if it is, then you know what you have to do, right? You have to get the total capacity, multiply by capacity factor. Then in this case here, we're going to multiply by 8,706. And then we would have the total annual production, okay? So that's what we have in here. And I think that's all we can do for now. Of course, we're not able to calculate the leverage returns because we have not calculated the cash flow yet. So let's going to go to the pro forma now. Okay, here we have the pro forma, the cash flows. And let's going to go up here. And what do we see? So the first thing I do when I go to the cash flows to understand what is in the header. Okay, particularly I'm interested to understand how this timeline works, right? So we have here year or yearly columns, right? So our periods is based on years, okay? So we have here financial closure date, which is correct, right? Then here we have some sort of date, and this is, again, this is the first thing. I'm not sure whether this is the 1st of August, right? Or if this is January 8th, okay? I'm not really sure, just looking on the numbers in here. What I really know, this is going year by year, right? And I'm not sure whether it's January or August. So the first thing we have to check here is see what is in the formula. And as you can see here, this number 8 refers to the month. So we are talking about the month of August. So every column here refers to the August of a given year, right? So I will change the format of this number later on. And if you follow my videos, you know how I like to do it, and I will do it later, how to format proper dates so that you don't get confused with the periods, right? So I'm going to go now to the last period and see where we land. So we have a 30 years period here, and that's the first thing that gets my attention to. If you go back to the PPA, we have only 12 years PPA, right? So, okay, so we have a 30 years period here, but we only have a 12 years PPA, and the PPA is for 250 megawatts, and we have a 340 megawatts capacity plant. So let's see what's going to happen here. There's something already that I have to start thinking of how to address. Let's go to production now. So the first thing we need to bring here is the production, right? So what do we have here? We have to bring the production. And what do we have here? We have period number 1 here. So should we have here ready the production here, or that should be number 0 where we have our capex. So I don't know, okay? So I don't know if this is the period 0 where we have our overnight costs and you plug the costs in here or not. So let me go down here. Oh, see, here I get the answer I'm looking for. We have here the costs, okay? The cost comes on the period 0 because this is an overnight cost or overnight financial model. So this is already a period of operation. Okay, so here we have our financial close date. So this is period 0. Okay, and here we have operations. Okay, so I got my answer. So that's gonna go back here, and the total production. We already have the total production, right? And I'm gonna say this is gonna be equals to. Sorry, it's gonna be equals to this number here, megawatt hour per year. So our unit is correct, right? So this is megawatt hour per year. And because here we have yearly periods, I will only refer back to this number here as being a megawatt hour. I also want to start formatting things properly. Okay, let's see if they have in here. They did not give to me. Let me see if you can grab this thing here. Let's see if this one here. Yeah, it looks like this one here. That's cool. So we have already the production here. So I was going to plug the production here. So it's going to be equals to this number here. There's no degradation, so we can basically copy and paste everything across. And then, of course, the number is not big enough. So I'm going to just select everything here. And I'm just going to just double click in here. And there we go. Okay. I'm going to change the formatting. Okay. I'm going to get rid of this comma here. Oh, okay, got it. There we go. Okay, so we have the input numbers in here. We have the reference back in here, and that should be okay for now. What is next? Contracted production. Okay, so that's the 250 megawatts that we had in there, right? So here is the thing, right? So what are we gonna do here? Are we gonna deliver 250 megawatts no matter what? Or we're gonna deliver the 250 divided by the 340, or 75% of our production? I don't know. Okay. If I were on her shoes, I would ask the question, okay, what do you mean by this, right? 250 megawatts, what? Whenever I produce above the 250, or yes, whenever I produce below the 250, I deliver everything to the counterpart, or I will only deliver 73% of the production, because there'll be some times. Let me give you more details what I mean here. There's going to be some times where we're going to be producing 120 megawatts, then 350, then 250, then 200, right? So what are you going to be delivering to the counterpart, or to the PPA, or to the off-taker? Are you going to deliver 73% of whatever we are producing, or are you going to be delivering whatever produced up to a max of 250 megawatts? This is not clear. However, because we don't have enough information here, I think it's a good assumption to say is that, like, we're going to be always delivering 73.5% of the generation. Okay, so I think that's something that could have clarified to the interviewer, but there's not enough information here, so that's the assumption. So whatever I'm producing, I'm going to be always serving to the off-taker 73.5%. Okay, so what the off-taker is going to get? Let's go back here. Let's go back here. So the off-taker is gonna get what? Let's go. I don't wanna make this a bit simple for now, and then we're gonna fix. So we're gonna get this divided by this, right? And we're gonna multiply this by. I'm gonna go back here, and I'm gonna multiply by this. Okay. I'm gonna press F4. What's wrong here? Okay, I did the wrong. Close it. Okay, so that's what we're gonna be delivering to the off-taker, no matter what, right? So every year we produce this much here, and 73.5% is going to be delivered to the off-taker. So I'm just going to do like this. I want to copy and paste a style here. And now I'm going to copy and paste everything across. And that's what we have here. Cool. Next, merchant production. So here we go. So whatever is above what we give to the off taker, that's going to be offload in the open market. Okay, so as a merchant, so basically what we're going to do, we're going to deliver this minus this, right? So that's essentially what we're going to be doing. So that's how much you're going to be doing here. I'm going to say this equals to this number here. I'm going to go copy and paste the style here. I'm going to copy and paste everything across. So here we go. And the actual quantity should be the sum of the two, right? Here, I want to copy and paste this thing here again. So let me see if I did correctly. Because I'm just copy and paste. I also want to have a top border here. Let me copy and paste across. And there we go. Okay, cool. So everything seems to be okay here. Let's go to the next one now. We have here the PPA. Have a price and we have an escalation. And I think we have all the information here. So if press equals, go back here. This is our price, right? So enter. And this is going to be our escalation. Okay, cool. So first assumption. We need to escalate the PPA price, right? Should we escalate it on the first or on the second year? And I'm going to assume here we're going to only start escalating this price on the second year, right? This is an overnight cost, an overnight model. And I'm going to assume, it's my own assumption here, I could have asked this. We're going to start escalating this only from here. So let's see how we can do it. So it's going to be this number here multiplied by what? 1 plus this number here, right? And now what we have to do, to the power of what? To the power of this number here minus this number here, and I'm gonna anchor this last number in here, okay? And I think, so that's 18. Let's see if we're gonna, what's wrong here? Okay, didn't anchor this number here. So I'm gonna copy and paste here. What's going on? Copy and paste here, it's still, no, oh, no, I didn't anchor the first number here. Okay. Okay, so I did anchor, so I'm going to the power of this number here minus this number here, which should be 1, and then we are escalating to the first period. And if I keep copy and paste everything across here, we are escalating the price as we move along on the years. So that's fine. Let's see what we have here now. We have the hub floating price, which I'm gonna say this is the spot price that we're gonna I'm assuming that we're gonna be selling the merchant production by. Okay, so this is going to be the price. You can see it's more expensive, okay, which also makes sense, and that's it. So what do we have here? Okay, so we have the revenues. So this is the PPA fixed price settlement amount, okay? So the calculation is already done for us, and that should be correct, right? So I'm just gonna copy and paste everything across to make sure that my calculation is correct, okay? So I would copy and paste everything across. As you can see here, just double checking that everything's fine. And this should be the merchant production. Okay, so that's what we have here. Floating price, actual quantity is okay, so that's fine. And here we should have the totals. Okay, that's fine. So we have how much we are going to be receiving, right? So this is going to be 15. What is this? Let's see. This is megawatts. This is megawatt. What is it? Oh, okay. So they are already dividing this by 1,000 for us, okay? So the units, see, you have to have units here. We don't have units, we just get lost. So, but it says here, it's in thousands of dollars, okay? So they already converted to us, but I got a bit lost because, again, I always like to have my units in here. So I would do the same as it is in there, right? So that's the way I would do it. I would add my units in here, but it should be, it's already here and it's converted. That's why. So this number here is $23 million or $22.3 million for the first year. Let me get some tea. Okay, cool. So we have the total revenues in here. Let's go. Operating expenses. So we got to calculate the operating expenses in here. So we are giving more information in here. Okay, so these are model inputs. I would rather have left this here, okay, not here. In my models, I never ever give any inputs on other sheets other than in the input sheet, okay. That's okay. That's what we have to work with. So let's see what we have in here. So routine OM, okay, escalate at 2%. So I'm going to also assume that they're going to start escalating from the second period. So I just want to grab, let me see if I did all correct here. I'm going to press F4 just 2 more times here. And I'm going to press twice here. I'm going to copy and paste across. I'm just doing this because I want to copy this information here. I want to paste here, and I should have the right formula. See? So let me go here. Yeah, so you see, that's why it's good to anchor things properly, because I was able just to copy and paste, or I had to redo my formula to anchor things properly. But now that I did, I just copy and paste everything across, and everything come nicely and neat with the right formatting. Now what I want to do, I want just to get rid of this comma. Okay, and now I just want to copy and paste everything across, and there we go. But let's see if it's calculating correctly, right? I don't know. So what do we have? $23,000. I'm gonna assume, okay? I don't know. So let's see. It's dollars per turbine per year. Yeah. So we gotta do some calculations in here, right? So what is the number of turbines we have? Yeah, it's not in here. Huh. Okay. So let me just gonna add here. So number of turbines. See, the information not there. So I'm just gonna open here. Just gonna save it here, and I'm gonna say the number of turbines is 100, right? So this is the number of turbines in here. And of course, there is no coloring the text. Why it's not picking up? What's going on here? Equals to this number? What's going on? Huh. Oh my gosh, it showed up here. What's going on here? Huh. Maybe let me just copy and paste this one here, style. Okay, now I'm gonna, yeah, something was wrong there. I think there was some indentation or whatever. It doesn't really matter. Okay, so we have the number of turbines. What do we have to do here? We have to get this number here, multiply by this number here, right? I'm gonna anchor 3 times, and I'm gonna divide by 1,000, okay? Why I have to divide by 1,000? Because everything here is in thousands dollar, right? So it's $2.4 million in O&M for the first year. Okay, that's cool. Then we're gonna have spare parts. So I'm just gonna double check everything's correctly. Yeah, so we have here the escalation. We are copying, or we are using the right difference between the years, so that's everything is fine here. So basically now, because I have the same units and the same escalation and the price in the same place positions in here, everything should be fine except for this number here. I should also anchor for the cell. So let me copy and paste, right? And now I'm gonna go back here. I'm gonna press Ctrl D, and everything is fine. If I copy and paste across, everything seems to be fine here too. So we have $500,000 for the first year in spare parts. Okay, PPA LOC fees. That should be PPA letter of credit fees. Okay, that should be it. So there's no escalation. There's a 2.5% on a $10 million letter of credit. Okay, so what I'm assuming here, the off-taker has asked the developer to have an LLC open, letter of credit, in the value of $10 million. And that's going to cost the developer 2.5% of the $10 million. That's my assumption. Looks logical. But again, if you don't know, just ask. Even if you have no clue what LLC is, just ask. I don't think it's going to harm you to ask it, right? So, but there's no escalation here, right? It's 2.5% of $10 million. So let's see, it's going to be equals to this times this divided by 1,000. So it's $250,000 per, yes, per year, but I have to anchor things properly. And I'll do it right now, copy and paste. And we have everything across, but I just forgot about one very important thing that I'm thinking of, huh? This PPA should be running for 12 years only, not more than this. And here, let me see what we have here. Yeah, I'm running it forever, right? So this is wrong, right? So we should only run it for 12 years. So let me say here, I'm going to go back here, and I'm going to grab this number here. I'm going to say here, let's say PPA length. Oops, okay, thank you. I'm going to anchor this here. I'm just going to do some, let me see, just some formatting here. Let's say, maybe like this, okay? I am also going to give this a green light B, and I'm going to just do like this. Okay, so it's 12 years, right? So let me just put in here years. Okay, so we should max this. We should limit this, right? So let me see what we have here. Should be this as long as what? As long as if. So we have to have an if statement here. So if what? If here if what? This number here, 1, 2, 3, is less or equals than this number here, 1, 2. Then we're going to have this. Otherwise, let me click here. Otherwise, it's going to be 0. Okay, so what's wrong here? Should be the other way around, right? So I hope. Let's see. Okay, let's copy and paste. Is it working? Yeah, it's working, and still have the PP up and running. Okay, so what's wrong here now? This is wrong then, right? Because this should be the difference between this and this. Okay, so there we go. So we copy and paste. Okay, now it's beautiful. Okay, so if you plug these things in here, it should be okay. See, this is the detail. And I only came to think about this when I was doing the PPA, because then I was thinking about how many years I have to pay this fees in here, and it should be the same logic, right? So I should only pay for this as long as the if statement here is correct. So I'm just going to copy this thing here. I am going to paste it in here. I'm going to get rid of the extra dollar sign. I'm going to close it and okay. See, let me see if this is correct. And I'm going to copy and paste everything across. And there's a false because I need to add 0 here. Okay. So this is the formula. So I'm doing the same thing. I'm just checking if the condition is true, right? So if the number of years we have here, it is greater or less than the numbers we have here. And if it is, we have to pay. Otherwise, we don't pay anything. Okay, so this is the first thing here, and that's correct. Land royalties, it's 1% of what? Of the revenues. And here we go. Okay, so that's going to be equals to this number here. 1, 2, 3 times the revenue. Where's the revenue? Here. I'm going to go here, copy and paste. And let's just check if we have the total operating activities, and we do have it. Okay, sounds pretty good for now. I don't think there's anything missing in here. Let's keep going. We have now tax items, and we have production, PTC production tax credits. So this is clearly coming from the US, right? So they have these PTCs, IBIs, all these tax credit schemes they have in there. I'm a little bit familiar with these. I have modeled a few things for the US in the past, but I'm not really the nitty-gritty on how it works. Let's see if I have any clues in here. So we have some lookup formula in here, and then we're multiplying what? We're multiplying, okay, the production, yeah, makes sense. So multiplying, we have production credits, so I'm getting the production and getting 0.028 cents per megawatt hour produced. Okay, so this is the incentive we have, and it goes for 10 years. And we have the price in here already, so there has to be a table somewhere where these things are being calculated. So everything's in this sheet in here and should be here. Okay, so this is also given to us, right? So I don't need to worry. So these are inputs, these are calculations. Okay, so it's 1% of whatever the PTC adjuster is. I don't really care. What I care is that the numbers is in here and we can use them. So let's see how we're going to use them later. Depreciation, okay, so we have the depreciation schedules in here. So this is, how many years is it? Let's go through. It is a little bit more here. Okay, it doesn't really matter. Yeah, it's 30 years. So what I think is happening here, we're using the max MACRS depreciation schedule. So there's some leftovers in here which does not qualify for that, most likely. It doesn't really matter, okay? As long as you have the depreciation rates in here, you can calculate, right? And the calculation is already being done for us because we have the number in here. So we're going to assume that this is correct, okay? So let's summarize where we are, right? So we have the revenues, okay? We have the operating expense. We have some sort of tax credit in here. We don't know exactly how it works, but we're going to find out later. And we calculate depreciation. So now it's time to calculate the EBITDA, right? Which exactly we have down here. So we have here the energy sales, which should come from this number here. Then we have the PPA, that's correct. So we have the total revenue, we have the total cost, which is correct, right? So now here you can see it comes as a negative number because we have to do the difference between the revenue and the operating expense to get to the EBITDA, which we have in here. Okay, that's cool. Let's gonna go down here. Now we have to calculate the leverage cash flows. So there's gonna be that, okay? And let's see how this is going to be done. So we have the project costs here, which should come from this cell in here, right? So, and it does, in fact, it's $500,000 or $500 million. I'm just gonna print this green because that's referring back to another sheet. Now comes the total or the term loan funding. So we gotta calculate how much money we're gonna be able to get here, right? So we don't know, but we know we have some information in here. Before we go to the term loan, let me just keep going here, see what they have here. Okay, now they come here and calculate that service that we have to take out from the total unleveraged pre-tax cash flow. So we're gonna have to calculate the debt now. There's nothing we can do about it. Let's gonna calculate and see where we land, okay? Let's go here. And the first thing I'm gonna do, I'm gonna just reduce to see what we have in here. What do we have here? Let me see. So we have, let me just make it a bit bigger. So we have the DSCR, the debt service coverage ratio. It's an input. So we're going to assume that we're looking for a 1.45 DSCR minimum across the full debt tenor, okay? Do we know what the debt tenor should be? Do we have the information? No, we do not. Okay, that's cool. What do we have here? We have some periods. We have 16 periods, okay. Then we have the risk-free rate, I don't know, okay, plus the spread. So yeah, the all-in rate should be 7%. So the all-in rate is 7%. That's fine. We are calculating semi-annual rates S1, semi-annual rates F2. So are we dividing? Yeah, so we're calculating the rates in a semi-annual basis, okay? We're dividing the 181 by 360. Okay, so that bears the question, should we use 360 as a number of days in a given year, even for the generation or only for the rates? That should be a question we could ask. I'm going to just keep the way it is, right? I think what is worth here is more the rationale that you're using and showing to the interviewer, like all this, that we're raising all these points, right? And there is 184 days to the to the second half. But it's so funny. It's so we have 181 here plus plus 184 here. So when you add those together, it's going to give you a 365, but we are only using 306 days to calculate the semi annual rates in here. Yeah, okay, whatever, the convention. Okay. So this things is more about conventions, okay? As long as you assess these rates and understand what's being calculated, and that should be okay. I'm fine with this. So we calculate the deflation here for each one of them, okay? For as we move along, Okay, that's basically what we're calculating here. Okay, so what we're saying here is that the 3.52% in the first semester equates to a reduction of 0.9 or 1 minus 0.996. Okay, the deflator 0.996. We're gonna for every dollar, or we're gonna get 96.6 cents on every dollar. Basically, that's what it is. Then you calculate for the second half. Here you calculate for the third half, the first semester, the second year, and so forth and so on. So I already don't like these things here. Okay, so you have each period here is 1 year, right? So and then you divide into semesters. Yeah, it's a bit strange, but it's okay. So we have 2 semesters here, 2 here, 2 here, and so forth and so on. That's okay. What do we have here? So we have our EBITDA. So I'm guessing it's coming from here, which it is. Oh, for the pro forma, let me just go back here. It's coming from the cash flows. Okay, so if I go back here, see the formula is divided by 2. I'm guessing it's divided by 2 because of the semi-annual analysis, right? And what do we have here? This is 1 year. Oh, and this is, okay, so there is 1 semester here, then the second semester, then the third, the fourth, the fifth. So there's a zigzag going on here. So again, I don't really like this. I think it's awful, but that's it, the way it is, okay? Most likely because, yeah, banks are charging your compounded rates on a semi-annual basis, but your project's running on a yearly. So you don't want to mix yearly timelines with semi-yearly debt. Okay, so that should be the reason why they're doing this. I don't really know. Let's see what we're going to do here. So the cash flow available, the cash available for that service. Okay, so what's that service? First of all, it's going to be the interest, oh gosh, interest plus principal repayment, right? Payment principal. That's what it is. So we got to add it here. So how do we calculate? So this is straightforward because we have this number here, right? So that service coverage ratio basically states by how greater your EBITDA should be, okay, compared to the size of the debt. Okay, so essentially what they're asking you to do here is to get this number here and divide it by this number here. And I'm going to just press F4 here. I'm going to copy and paste everything across, okay? Let me see if this is correct. And I'm going to copy everything across in here. So this number here, okay, so they're divided by 2 because we're getting the numbers from the EBITDA in the pro forma. Okay, so what are you doing here? Say, look, out of my EBITDA, okay, or my cash flow available for service the debt, cash available, yeah, out of my EBITDA, which in this particular case here, you can assume that it's going to be equal to the cash flow available to serve the debt, okay? This particular case, we could have asked that too. We're going to be able to get a debt service equals of this size in here, okay? And this number is being calculated by the DSCR. That's essentially what we're doing here. That's good. Let's go back here. Principal repayment, right? So what is it? This is the beginning balance for the debt service, so for the debt, okay? Okay, how much principal repayment? I don't know yet. We're going to come back to this later because what we need to calculate first is the interest rate. And we have the number in here, which should be coming from up here. Okay, so the interest rate is much easier to calculate. Always start by the interest rate. I think it's much easier, okay? It's going to be what? It's going to be the open balance times this semi-annual here. I think it should be this positive or negative. I don't know. Let's see. Let's leave positive by now. Okay, we might have to change the signal of this. So this is for S1. And we gotta go back here. So S1, S2. So we gotta copy this number here and plug it here too, right? And then we have the open balance here and here. Okay, so let's gonna copy here. Nothing should be right here because now we should calculate this number here. How are we gonna calculate it? So we have the total that service available for us, and we have the interest. So now here's going to be the difference, going to be this number here minus this number here, I guess, I hope, copy and paste, right? And here we're going to do the same. So it's going to be equals to what? It's going to be equals to this one here minus this one here. And copy and paste. Let's see what's happening here. I don't think the number is right here because this should be uh, this should be 1 point. So this number here should be equal to 1.45, right? But it's not. So let's see what's going on here. So here we are adding these two things together. So here should be a negative number. So let me do here. I'm going to just close parentheses, multiply by -1. I'm going to copy and paste across. Okay. And I'm going to copy and paste across here. Let me see if this is correct. It should be wrong, right? It's wrong. Okay. So I'm going to do, yeah, I have just to multiply here by -1. Okay. Oops. -1. Multiply by -1. I'm going to copy and paste. Okay, so what do we have now? Apparently it's correct because I see a number 0 here. Yeah, so we have a 0 here. So seems to be okay, but like, are we really willing to repay this debt in 16 years? That's another thing. It says here years 1 to 16, so we can assume it, okay? But most likely in a project finance, what banks will ask you is to marry the length of the debt to the length of the PPA, even a bit less. But okay, let's leave the way it is here. Okay, we're gonna assume. But that's another good question you could have asked the interviewer. Okay, we have the answer here. Let's just gonna double check everything's correct. Right. So we have this open balance. We repay the principal, and this is the end balance, which is gonna plug in. This case here is gonna plug in here. Then we repay the second one, and that's how much interest we're paying. Right. Okay, so we calculated these. Let's see if we have enough information to fill out the table here now. So what is the total loan funding? So it should be this number here, right? So this is the number we calculated here. It was given to us because of this number here, and they calculate in here. I'm not gonna go into the details here because they're giving this number to us, right? So using the deflators and the EBITDA, okay? This is a simplification in the model, okay? Usually when you do this, when you scoop that as we're doing here, okay, where you determine the minimum DSCR you want for your project, there's a circularity that shows up in the project, okay? But here, because we are only using real values for revenue, for cost, for everything, we can go around and do this simplification, okay? But that would return us as there would be a circularity, like whenever you calculate these numbers in here, which we don't have in the model here. And in one of the previous the future videos, I'm gonna go and cover circularities when sculpting your debt, okay? But they got around this, and I'll come back to this later on. But that just to keep in mind, okay? And I'm not gonna go into how they are doing these things here, okay? But essentially, this calculation in here determines the maximum size of the tenor or the debt you can take, so that every single period you have that coverage, which is 1.45. Okay, that's essentially what it is. So there's a simplification here. Just keep this in the back of your mind. Okay, there's a huge simplification here in the model. Let's go here. So we have 145 here. Then we have this number here. We have the debt service. Okay, so this is the interest plus principal. It's going to be equals to what? It's going to be equals to, let's see if we have the information here. This is the cash available for that service. Yeah, this is the number, right? But this is only in a semi-annual. Let's see. Here we go. They have the numbers in here. Cool. So we have the debt service. So this is going to be this number here. Should it be negative or positive? Should be negative here, right? Again, sorry, press F1 instead of F2. So I'm going to multiply by -1. Okay, that should be reducing my total unlevered pre-tax cash flow. Okay, I'm going to copy and paste everything across here. And here we go. For 16 years, we have that. That's perfectly good. Okay, so then what are we going to have here? Federal income tax. Let's going to give a think on this and see how to do it. So we have two tax items in here. What are we going to do here? So, and then what we have after, we have the taxable income loss. Okay, there's a typo here, doesn't matter. Here I think, and then okay, so then we're going to have to pay our tax. Then we're going to have this thing here. Okay, so I think here, what we're going to have here, we're going to have our depreciation, and here we should have the interest. Okay, that's what I think that goes in here. So depreciation should be up here, whereas depreciation should be this number here times -1, and that should, sorry, the interest should be this number here, also times -1. Okay, so we have, I think, I'm not sure, let's see, yes, EBITDA, then we have the taxable income, so we have to take off depreciation, amortization. These are the two things to consider in this project right now, and that's what we have. Okay, cool. So now we have negative taxable income, which should become a benefit to the project. Okay, so it's not really project finance. So if you can take credit, or if you can use it as a benefit. Okay, let's see how it is. Not really sure. Let's see. So now I have to take 21%, right? So we're gonna get this number here, press F4, multiply by this number here, but we also have to multiply by -1. Okay, and I'm going to show you why. So let me just copy and paste here. Okay, so here we have a positive taxable income. So because we have positive taxable income, we should be paying tax. And the other way around, whenever we have a negative taxable income, in principle, it's a benefit to the project that you can add it off against some other cash flows you have or some other taxable income in the company, or you can carry forward this loss to offset in future years. Okay, let me just copy and paste everything here. So we calculated the tax benefits or liability here. Okay, so now we have a plus tax item 3 here. What the heck is it? Let's see. I think there's this PTC production tax credit here, right? So we have this benefit in here. Is it $33 million? Is it correct? Wow, that should be wrong, huh? See, like we don't have the units. Let me see the units down here. You see, we don't have the units here. I'm gonna assume this is 0.0 cents dollar, okay, so it's USD per megawatt hour. I don't know. Okay, so we should have the units here. That's very annoying that we don't have these things in here. Okay, and if this is USD per megawatt hour, then this number here should be divided by 1,000. Otherwise, it doesn't make any sense, I guess. Getting $33 million as credit doesn't make any sense, right? Out of a revenue of 22 million, it doesn't make any sense to me. Or it does it. I don't know. I really don't know. I don't know. I don't know what to say here, really. But I'm gonna assume this is we're gonna receiving 2 cents of dollar per megawatt hour per kilowatt hour. Looks too low also, right? Huh. So let's go back to, let's assume this is per kilowatt hour, okay? It's 2 cents, otherwise too little also, right? 2 cents per megawatt hour is too little. And if this is the case, there is no thousands here. And then it's just a huge number, unbelievable high number. Like just think, right? So we're having 33 million tax credit out of 22 million revenue. It is just insane. If these are the numbers they have there, that's pretty good. So we're going to have to link this to this number here, and it's going to be a positive because that's a tax credit. So it's a tax that are going to avoid paying. Okay, so I'm just going to copy. What's this? Okay. Oh, okay. Cool. So we have they give us kind of a hint because they put this like a gray Okay, so just gonna copy these things here across, right? And here we have the leverage federal tax liability or benefit, I would say, right? Okay, so this is how much we would be paying or receiving as tax. Okay, $51 million, that's pretty good. This number is here. So what do we have here? Leverage after tax cash flow. Okay, this is what we have in here. And what we have, it's a bit weird now. Oh, okay, I see. So we have the tax benefit plus our pre-tax cash flow, which is this one here. And when you add it together, you have the after-tax cash flow. Okay, so this is essentially how much investors and leverage one. Okay, because you only have the equity, which is the difference between the total capex minus the debt we took. Okay, and that's basically it, right? So I think that should be all right. Just want to check here. Yeah, we have the debt. Here we have the interest, we have depreciation, we have the tax. Looks like this is it for the model, right? So we have here the cash flows to the equity investors. And I think now we can calculate the IRR. So the IRR should be equals to, we can use the X IRR in this case here. The first thing are what? The values. So we're going to grab this number here and we're going to go across and then we're going to grab the dates here to here and then say let's 0.1 as a gas. I'm going to close and there we go, 11.56%. And here we're going to use the X NPV. Okay, essentially it's the same thing. Okay, so what rate are we going to use to we're not giving any rate here, discount rate, right? So we're not giving, let's say 0.4%. This is equity, right? So it should be a bit higher. Let's say 8%. Values. So we're gonna get the values in here. Let's see the cash flow again. Should be this one here. And then we're gonna get the dates, which is up here, right? So it's which is here. We're gonna close it. Okay, 80,000 or $80 million. Okay, so that's basically it for today, guys. So this is how I would go about it. I'm going to record a second video on what I would do differently here in terms of structure, in a little bit of calculation, so some units. So I'm going to do it for the second video, okay? But that's basically it. I hope you have learned and enjoyed. Please subscribe to the channel, and I see you in the next video. Bye.